Hey, hello, this is Martin from Secrets. Welcome to Markets Next Week, the weekly stock market analysis show, where we look at what happened in the market during the previous week and try to learn something from it and then plan for a better trade for the next week. All the season's greetings to all the subscribers. And today we are going to have the analysis for the week that's starting from December 26, 2022, the last week of the calendar year 2022. So let's get the charts and see what happened next. So this is the weekly candle that you see, and it was bloodbath, literally, right? Look at the candle size of Nifty and the Banknifty, right? Huge dip, huge crackdown is what exactly has happened, especially in the Banknifty, which had shown a lot of resilience in the previous week, had actually cracked down along with the Nifty, and still there is a previous resistance zone which could act as a support zone and then bounce up could happen, but it was a big fall that has happened now. The correction has happened up to almost 5.7% of fall, right? And all the gains that we had from the breakout from the previous resistance on both the indices are lost. Look at the daily candle. The Friday's action was a gap down with a huge dip as well, and multiple. So there is a gap, beautiful gap support here, that's gone. And if you also had a gap, that is also gone, and it is a gap down with 3 consecutive weeks of bearishness. So Wednesday, Thursday, Friday wiped out all the gains. Until then, there was hope that it was on the edge, but now that's all lost. Look at the Bollinger Bands, where the consolidation is over now, is done with on both indices, and now it's expansion on the downside, as you see, and it's in fact walking on the bands, and which clearly indicates a bearish price move further ahead, as indicated by the Bollinger Bands. So this is another view. We had the breakout zone. It did break out for multiple weeks, made fresh all-time highs multiple times on Banknifty and a couple of times on the Nifty as well, and then it last 3 weeks was retracement, and it has now done nearly 6% of retracement, very close to the weekly moving average of 20 on the Nifty. But Banknifty is all good except that inverted hammer on the top of the rally, which was bearish in nature, and that was what Banknifty had drawn. So this is a single week which wiped out all the gains, and 1000 plus. We'll see the exact figures in the slides. So 1000 plus points lost in one single week, and one of the biggest crackdowns in the Banknifty in recent times. So let's go back and see the numbers and what we lost and what we gained. 464 points lost. It's more than 2.5% of pullback has happened in the Nifty, and it was 1553. That's 3.6% of all that has happened on the Banknifty. So both have formed wide range bearish candles on the weekly, and Nifty is closed below the 20 weekly moving average, and Nifty is closed about. So all the gains that the breakout had cost is wiped out now. Still there is a possibility of a bounce from the change in polarity perspective. If you know, it's a possibilities that's not confirmed yet. And the gap down on the Friday, it was Wednesday, Friday, Thursday, 3 days. Friday itself was 320 points down on the Nifty and 740 points on the Banknifty. Right? That's a big crackdown that happened the last 3 days, just day before the people leave for the Christmas and New Year celebrations. Did that happen? And the Bollinger Bands expansion downside clearly seen with 20 median is all gone. Now let's get to the levels and see where we can look forward for the next. So it's the Fibonacci retracement level of 50 which is breached, which could act as support if it managed to climb up, right? It's for zone, and then if that does not hold and it falls back into the wedge, ascending wedge from where the breakout had happened, the resistance, trend line resistance, it could fall back into that wedge. So it could find a support at 17,642, and after that 17,569 is Fibonacci 61% is on the daily chart. So Fibonacci 61% is very crucial, right? It's no longer a retracement if the 61 Fibonacci is violated. It means that it's downtrending. It's over. It's not correction anymore after that. So we'll have to keep a close watch of the 17,569, 670. That's what 17,570 is going to be crucial. 17,500 is a rounding number that also could act as support. You have 17,429, 430 would be support, and then after that you have the gap support at 17,328 nearby levels. Similarly, upside, Fibonacci 38 from where it had fallen down, it was a previous swing low as well, and rounding number, yeah, so that 18,000 of course will be a resistance to clear that. Before that you have the 17,950, which was a major support, 959 from where it's, that would all these supports would now act as resistance on the upward journey if it all moves up. 18,262 similarly would be resistance after the 18,000 is cleared, and then 18,442, 18,530, like that it goes. So the target of this breakdown of the head and shoulder on the daily is almost complete. As I said before, head and shoulder always work on shorter time frames that effectively, but it has worked out and the target is met. Target is not only the height of this shoulder, height of the head part of the head and shoulder. So just for information. So we are looking at the support resistance levels of Nifty. We're done with that, making note of these levels, and then Banknifty, if you move on, you have the support seen at 41,580 levels, 41,840 levels, 42,225 levels, and then Fibonacci 23, 42,559 will be resistance upside, 42,961, 43,000 rounding number, all this can be resistance, and 43,339, 43,615, and 44,151, the all-time highs are all the resistance on the upside, supports on the downside. So if this current support is breached, then you have 41,184, and then if Fibonacci 50, 47,86 could be support zones downside. If that's gone, then 4,500 and 4,200 is a previous swing low, good support. Right, so these are all the supports. The supports are a combination of the previous zones where the breakout happened, previous supports now turning as resistances, and the Fibonacci retracement levels. So after Fibonacci 61, there is no point in looking at that. That's all. Right. After that, we will have to look at Fibonacci extension. So now it is a retracement that is happening. It's no longer valid after the 661 retracement, as I said before. So making note of the support resistance levels along with that, what the OI levels are indicating closer to the expiries. Now looking at the momentum of the trend, the momentum on the weekly basis is what you see on the left side for the Nifty and the Banknifty. So weekly momentum has slipped slightly into the sideways zone from the bullishness. So the bullishness is over from the momentum perspective, at least for temporary. We'll have to wait for next week or also in order to see whether that so that slip is for real or not. But the ADX has not crossed over yet on the medium term or a weekly chart, so it's about to cross over on the journey towards that. Right? That's what we get into. So from the momentum, if you see momentum is slipped in the sideways from the medium term, and it is slipped with the bearish zones on the short term on both the indices. Now the ADX has already crossed to the bearish zones on the short term, DMI negative, but the positiveness of the DMI on the medium term maintains there, but it's both are having it's having falling strength, not enough strength is there in the bearishness on the medium term, but it's a fall. In the short term, the ADX has gained strength in both indices. That's so overall momentum is short term bearish and long term just getting about to cross over the trend. It has not happened yet, but we never know whether it will happen or not. It will come to next week only as per the ADX indicator. Volatility is where everything happened last week. 15% of our move is 16.6. Imagine we were at 12.5 kind of levels. This is the major support, and from there we have a big spike, and last week alone it was 15% of up move. Previous week it was 13%, I think. So big spike ups in the weeks has happened, and now we are above 16 of weeks, and we'll have to be careful. It's not too far from the 20 levels considering the mean trading nature, especially in trading with options and derivatives, you have to be carefully observing the wicks. Option interest is bearish again, with the Banknifty showing long unwinding and short build-up in the Nifty. Long futures open interest is what we're talking about. Futures open interest for the options open interest for the December 29, the monthly expiry, which normally expires and normally explosives or more volatile. So for that, the PCR is nearer to the bearishness than towards the above one PCR. So put call ratio is also showing some kind of bearishness is indicative there as well on both the indices for the monthly expiry. So, right, so bearishness is there. Look at the levels for the options OI for the next week's expiry, monthly expiry on December 29th, 17,000 and 18,000. That's the kind of levels we're talking about. 70,500 support and all this, but option writers see the risk there, calculated the risk and written the puts at 17,000, very far away from the 18,000, which is where the call rate is seen maximum. 70,500 and 90,000 also seen as his next level of highest put and call rating zones for the Nifty, and 40,000 and 43,000, 3,000 point gap. Look at the range difference between last week and this week when the premiums have increased. This week has spiked up, and then the range also, the standard deviation, the range where the option riders are betting on is also widened 3,000 points before 4 days from the expiry. 41,500 and 43,000 is where the Bank Nifty's second highest of put and call rating is seen. Support resistance seen there. Put call ratio is bearishness, and bearishness in the future. So I build up for Friday also. We have already seen. So I is also negative. Right. So let's just wrap up the industrial sector, how it performed. In IT had a 1.6% up. It was across the sector fall that happened last week. In IT was down, metal was down 6.5%, pharma is 1.2%, auto 4.2%, FMCG 2.2%, reality 6.8%. So the biggest knock was on the metal and the reality. 6+% down single week. So that's what happened. Right. So all these green is seen in the pharma sector with 1.2% up. Pharma, COVID. Right. So that's how the market did the bank selling last week. So none of the sectors are bullish, of course, and most of them are turned into the bearishness in the short term. Right. Almost all the sectors are in bearish zones on the short term, and some of them are hanging on the sideways in the medium term. So that's how the sectors are performing from the momentum perspective on the short term and the medium term. Let's look at that once again. So the IT sector had a sideways medium term, falling down after hitting resistance, and again all-time high resistance hit, and then falling down with a big fall of 6% above on the metal, after making a big wide range bearish candle, falling down into the neckline of the breakout zone from where it was breaking out a few weeks back. Can you believe it? Auto has given up all the gains, and pharma fallen back on the trend line from where it had attempted to break out and fell prey to the resistance, but it seems like it's taking some support there. Medium term it's sideways. FMCG is also breaking down and slipped to the sideways in the medium term because it was most bullish in recent times. Reality also seems to be going back to the neckline from where the breakout had happened months before. Trend has crossed for the bearishness, of course. Momentum falling down, momentum seen there with the reality. So that's a wrap up of how the sectors performs and what we can look for how the sectors could perform in the coming weeks from the momentum perspective, of course. Index heavyweights, HDFC is doing good. Probably one of the few stocks that's doing good in spite of all this drama. So we had this flank pattern, it's still not broken, it's well within that range bound move, and then it's maintaining the bullishness with a positive reverse divergence, which is bullish in nature. And the momentum is still much above the 60 RSI. Trend is also rising up and then bullish. In the medium term we talk about. So HDFC twins holding on with bullish momentum, even though pullback did happen last week, and it was big pullback as well. Right. So Reliance it was doing doing sideways since long time. After the breakout happened, it looks like it's heading towards that same neckline from where it had broken down, and the momentum is just about to close. Not momentum, the trend is just about to cross over to the bearishness, DMI negative zones on the medium term as well for the line. So sideways there, but the HDFC is that's still maintaining the bullishness despite the market falling such big. Infosys, yes, met with the resistance when the Nasdaq affected the same, and then it has been falling down and almost getting into the channel from where it attempted to break out. Huge resistance on the upside for TCS as well as Infosys, especially Infosys. So overall medium term sideways is what you see. Now ICICI Bank also had slipped in the sideways now and set the neckline point where there is a possibility that it could consolidate at the zones. There is trend line support also seen there. It almost closed down. The ADX indicator shows that medium term bearishness is already just about to cross over, you can say probably. Kodak Bank has been consolidating within that range bound moves, sideways moves continue. That's all the so index heavyweights, HDFC the star, lines hanging on, IT at resistance, ICICI Bank getting the sideways bullishness is over. Kodak sideways as usual. Let's wrap up. Moving on, how the institutions performed. It's an interesting story here. Contrary to what people would have thought, the Fyers were not selling much last week. It was only 570 crores of selling happened, and it was DIS who was buying 8,500 crores. Still the market fall. So who was selling? It was profit booking from the normal retailers who thought the market will crash. No, it's panic selling that happened last week. Derivatives also institutions had shown some movement in the downside. Longs on the derivatives have put down. So that's a problem of institutional participation. So it's okay. It's not that scary as we thought. No, it's the panic selling that might have happened last week, and then once the news gets digested and people get to know the facts, probably this breakdown may not continue unless and until the institutions also start participating in this. Right. Now, look at the global markets. It's already moved all over. The commodities also will analyze. Like so, dollar. It was small fall less than 0.5% and 104.32, but still very not too far from multi-year high levels. And sideways movement is what maintains. So dollar is falling, but rupee is not getting. USD I now look at it is again flat, maintaining the same 82 plus levels, 82.76 was close. Not too far away, not too far away from the 83.56 kind of all-time high level. So rupees continue to be break even though some pullback is happening in the dollar side or dollar index side. These markets, yeah, it was like a volume would have been there because of the festive season, but it's kind of less than 0.5% red on the Dow Jones, flat close on the S&P 500, which is a broader index, and Nasdaq also fell 2%. So it is a red movement. If you look at the US markets, it's all having a descending wedge on all of those in the weekly. And Gilgly said it was in reversal mode, but last week some green, some attempt to hang on there instead of falling down, reversing down black into the bottom of the wedge. Some attempt to see in the Dow Jones at least, but Nasdaq seems to be not listening into it and heading far down towards a support zone basically. Right. Even the S&P 500 also is formed in decisiveness and he's thinking of hanging on there, but the reversal journey has already started. There is a trend line support. We have to keep a close watch of that confluence of the previous support and the trend line support that is formed now. Whether it's going to break down or not. Even if it breaks down, we have a long way to go before the support. So it's sideways action that you see, trying to hang on there, but medium term, we know what is going to happen. Right, unless a breakout happens from here and reverses everything back. So as of now, you have to be concerned about the US markets after the holiday when they comes back and how the Fyers are seeing it, and then they're going to sell off further and then go back to the bottom of the wedge, or is it done with and we have a breakout from here or not, right? So huge moves on the US markets would have impact on our side, our markets, Indian markets, If there are huge moves, we would, we cannot hold on to be resilient, for a longer time. Although, we had been performing very good, right? When big sell-offs happen, when panics happen, nothing happens. So close watch of how the US market is responding to this COVID fear itself, right? So we had not listened to that because we had been listening to the local cues more. Is what has happened last week's fall, right? So now, if the US markets also reacts the way we behaved for the then we would have trouble. Otherwise, we should be recovering this just the same speed as we had given it up. But the fact remains that we had lost all the gains in the last multiple weeks. Crude oil spiking up again and climbed in the sideways. As you can see, momentum. There is a very bullish divergence of this, worked out perfectly, and this climb in the bullish zones. So it's a trend line channel, and there is every chance that it can move up. But as long as it maintains its levels below the 80, 90, 100 kind of level, should be okay. Hope it doesn't go back to this all-time 30-year high level kind of level. So crude spiking up is not that great news. The dollar is consolidating after having made a good up move, and then it's trying to hold on to stay in that resistance zone room. But in the medium term, we have a cup and handle formation that's happening very, very slowly in a sideways move on the medium term. That's what gold is doing. It's a hedging instrument, comes in very handy when we have market that slips 700, 500 points in a day or in a week. Right? So keep track of the gold as a commodity as well. Normally when the markets are down, the gold performs. As of now, it's not performing, but it had given a good pullback in the last several weeks and continues to hold on that gains. Two topics. Dixon negative short side. Dixon Technologies, an IT company related to some chip manufacturing, something. But the chart's looking that it's in a parallel channel. It's there is a chance that it could break down from that support zone, and that will be the opportunity that we have. The momentum has already given the indication that it has slipped into the bear zones, and the trend also has crossed over the bear zone. So that could give very good risk reward, and until drawing the next support zone and then trade your stop losses. Another sell is realty sector stock, Brokerage properties basically. So realty had fallen 6% bow, and it's a head and shoulder pattern that seems to be breaking down from that support zone, and then getting entry after the candles low could give would risk reward till the next support zone on the short side. So short trade opportunities in Brokerage properties and Dixon Technologies. Another strategy for the next week could be to play the Nifty with a double dial kind of respond now that the VIX is spiking up. Basically, it's nothing but selling of 18,200 and 17,450 put and basically 17,450 put and 18,200 call. We're selling that for this month, and then for this week and for the far week we would be selling 17,000 and 18,550 as a CE as a hedge. So it's fully risk defined. You should exit before the expiry for sure, Wednesday itself. And roll on and roll up in case your neckline, if your selling point out here is getting breached. Right? And the advantage that VIX spikes up, the value of the calls does not decay much, the value of the buys will not decay much, and you could save yourself from, and we get a basically a wide range. Look at the range that we're getting. As long as the Nifty maintains, does not break down to 17,400 levels, that's already 400 points down there we're talking about, right? That's a range that we are getting, and we're getting a similar or much more bigger range on the call side as well. So that's the benefit of that. Probability also is good, near to 80% of probability of profit is there, and that should be a risk reward. You won't get much, but you'll get little, but you'll get that little every week consistently. And that's how you have to play the options. That's how you have to play the trading. Unless you are a hardcore buyer who is ready to have bigger drawdowns and then hang on for that day when you get big gains. Yes, now that we talked a lot, let's wrap up for the next week, and what happened last week is very evident. It was the indices cranking down, with Banknifty is holding down, also joining the bear party, and the bears took over the entire scene, and then 5.7% of correction overall from the top after breaking out from an all-time high level, and that's where we are. 19,000 is history now. We're talking about when would we break that. So just few weeks back, that's what we were talking about. Now that's not the story. The story is how long would we go down, where do we stop. So that's how markets behave when the least is expected. It gives you surprises. So trend and momentum indicators for the both indices and the bear zones. Bollinger Band is expanding downside bearish. Open interest is bearish. PCR football ratio is bearish. VIX is rising up. 17-15, that kind of percentage is up for a week. And US indices definitely in the reverse indication is there. Price action is negative overall in our markets. Both indices all gives me to think that some more correction could come in the coming weeks, and it's a moderate bearish view that we have. That's what the chart's saying me. Now, one thing notice that the Fyers are not selling last week. They are not joined the party of selling. If they also come in, then we may have more correction. If they're not coming in, and it is just a panic retail sell-off that has happened, then we may be good and we may consolidate for some more time and climb back to the sideways on the short term. US markets is not something we have to keep a close watch, as I always say. Level cues, recession fear, inflation, Federal plus high claims, and all these things could come in as surprises, and then could create a lot of volatility in the markets. Right? And crude oil is also again spiking up after a lot of down move below the 73.4 kind of levels, and now it's spiking up above, almost touching the 80 levels, which is spiking up 15%, and then almost above the 16, which is just 4 points from the 20, and then if it's above the 20, stay out of the trade, and then if you're not a ultra professional in the options, right, the best option would be to stay out if the VIX is spiking about 20 or 25 kind of levels. Premiums increase, volatility ranges increase, so things could suddenly, the regime seems to be slowly changing from lower VIX regime to a new VIX zones. We never know that, or are we falling back to the lower VIX regime again? We never know. The Monday would tell you the story. Next week would tell you the story. Right? So what we can do is watch out for the levels that we get studied so far. It's 17,500. 40,500, so the levels to watch only. Then if you the Banknifty on the downside, and upside 18,300 would be a good zone to hope for the bulls for the price to move up further up. It's 43,700 in the Banknifty, right? So it's one thing that we need to keep close watch is our investments that we have done. If they are quality investment that you had put in for long years to come, then you just can't sit there and then lose the money, right? So you have to do either you cut off and then take the loss and then come out of the trade, or if you're on profits, book the profits, cut down the position size, or apply option strategies if there are futures options. They are under the futures and options and derivatives and all that. Get rental income from option strategies like cover calls or cash secured puts, averaging and all that, right? So playlist has got videos on that, check out that. So always have hedge positions if you're playing with options, and don't carry overnight risk, which could wipe out your capital when this kind of falls, like what happened on Friday and Thursday. Right, so always protect your capital is the only thing that we can do. So you are primarily a risk manager. If you're a trader, that's what your fundamental duty, and fundamentally that's what you are if you're a good trader, profitable trader. So that's what you keep always close watch. Protect your capital, cut short your position size, VIX is spiking, stay out of the trade if you don't enter trade, have hedge positions, and right, look at the probabilities, right, based on support resistances and all this momentum trend and different parameters that we have studied so far. So if this market study has helped you some way to have a better trade plan for the next day, then definitely subscribe if you're not done so. Share to your friends, please, and that's the only way we can get some subscriptions that to keep us motivated for making these videos in the coming weeks. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.